Hello, good morning. Okay, let's start. Today we're going to finish chapter 2. You're going to see your first homework after today's class. I'm going to post the first homework on Moodle. The due date will be next Wednesday, so you have 1 week to do your homework. As the homework, you need to, one second, let me get all the students in. The homework, you need to send your answers to my email address. Okay, you don't need to type all the question things. You just need to type your answers. Okay, should be very easy. It won't take you a very long time. The first homework will be just some questions asking you to prepare a very single income statement like this one. Like this one, asking you to calculate a very easy type of income statement. Okay, so you need to do these things. So on your homework, if I give you a question like this, give you a bunch of items, informations, ask you to prepare a very simple income statement, you need to do these things step by step. Okay, follow the step like this. Please do not just give me the answer. For example, the net income. Okay, you need to tell me how you get those numbers. Okay, so once again, for the student that come later, for the student that come later, the first homework will be due next Wednesday. I will post that today. Okay, you have a whole week to do that. Yes, Margaret, you raise your hand. Do you have any questions?
Hi, yes, I do. It's not related to the homework, but last class we said that the cash on the balance sheet is equal to the ending cash reported on the statement of cash flows. And I just wanted to double check the ending cash balance. Is that the cash flows that comes from financing activities, or is that like free cash flow, or what exactly is that? Because like it says on the chart that you gave us, change in cash, beginning cash balance, and
Yes, it's right here, right? This is the slide. This is
sorry.
okay. So once again, very good questions. Okay, so you're asking about how we gonna get this cash. Okay, so in this case, you see that because the beginning, okay, 1 second right here, because the beginning cash balance in this case is equal to 0. Okay, is equal to 0. So that's why you will see the change in cash, the ending cash balance, it will be equal to your beginning cash balance plus your change in cash. But however, what if, okay, we're gonna actually spend more time to talk about the detail of the statement of cash flow in the future chapters. But normally, the beginning cash balance, it won't be equal to 0. So for example, what happened if your beginning cash balance of September 1st, 2018 is already equal to 1,000? Which means you already have $1,000 in your hand at the beginning of the month. And then during this month, the total change cash amount is equal to 13,000. So what should be your ending inventory right here? What should be your ending cash balance here? It should be equal to this $1,000, the money you already have at the beginning of your month, plus the total change of the amount of money you gain of this month. So the total money at the end of this month, it will be equal to 1,000 plus this is equal to 14,000. Okay, that's actually a very good question, Margaret. I thank you for the questions. Some students, they may think because they directly see the change in cash in our questions here, in our example here, they think about the change in cash is exactly equal to the ending cash balance. So they may think about the cash you're gonna need to draw from the balance sheet is equal to the change in cash. Okay, that's not the case. Okay, you need to get the ending balance of your cash flow in order to put it on your cash right here. Okay, I don't know whether I answer your question correct, but we're gonna spend more time to talk about the statement of the cash flow. You see a lot of activity here. This is what we call the direct way we're going to provide for our cash flow statement. However, as I mentioned during our class, this is a very introduction of the financial accounting. We are not going to actually spend a lot of time to ask you to prepare a very detailed cash flow statement. But very good questions. Once again, in order to calculate the ending cash balance, we actually going to spend some time to talk about these things. You're using your beginning inventory or the beginning, you're using your beginning cash balance. So you get the beginning cash balance plus the change of the cash. It will be equal to your end cash. I need to get a blackboard. This is just terrible. Anyway, so make sure you understand this. But if I can understand why you're confused. But very good questions. I hope I explained clearly so you understand right now. Do you have more questions?
I just want to clarify. So basically, we're using all of the what's it called? We're taking the cash flow from operating activities, investing and financing, and seeing what has changed from the beginning of that balance to the end, and we're just either adding or subtracting it to get the end balance.
Yes.
Okay, perfect. Thank you.
Okay. And once again, for a student who come later, you're gonna to have your first homework. I'm gonna post that on Moodle today. The due date is next Wednesday. The homework will be majority about asking you to prepare an income statement like this one. So make sure you follow step one by one and send the answer of your homework to my email only. Okay. So last time we stopped here, talk about gains and lose. Once again, the gains is your sell actual value, for your inventory, for your product. For example, you used to sell your product for $10 and now you are able to sell your product for $15. So you have a $5 gain, okay? And loss is resulting from the selling of the item for less of the item it worth. Okay, so for example, you sell the item for $10 before and now you only can sell it for $5, so you have a loss. So you will see the income statement will become like this. Your revenue plus any gains minus the expense and minus any loss, and then you can get your net income. Okay. So the question you probably see on your homework will look like this. Again, you have two small problems. Trust me, it won't take you a lot of time. Okay, so it's the beginning of the semester. I don't want to give you a lot of homework. So, but still, it may take you around 10 to 15 minutes to finish the homework. Some students may take maybe 20 minutes, but it won't take you a long time. Okay, the homework you're gonna see will be like this. So for example, the first question, it gives you a lot of information about each month. Okay, and this is a bakery store for the year of 2019. The first question asks you is calculate the net income or the net loss of January. So in order to do this, so it's asking you the January. So we need to find out what's the key information, what's the information you should use in these example questions. So you need to find out the revenue of the January, okay, and you need to find out the gains of the January. You need to find out the loss of the January, and you need to find out the expense of the January. Okay, so once you know that, we're using our revenue plus any gain minus any loss and minus any expense. So we can get the January. So in this case, the revenue of the January is equal to 22,500. I'm sorry. Plus gain, the gain is 0. Okay, and I'm sorry. Okay, and minus any loss, the loss is also 0, and minus the expense is 2760. So what we have is actually, because this 20 didn't count, so we directly using 22,500 minus 27,600. Okay, $760. Okay, so you can get the net income of the January. Okay, and for the February, we're using pretty much the same way. So let me show you the answers here. Okay, so once again, in order to get the January, we're using the revenue. So how we get this number? Okay, so we're using revenue minus the expense. Okay, so we get this number. Okay, and how we get the net income and net loss for February. So we need to find out what will be the February things. Okay, so for the gains of February, we do have some gain during February. Okay, and the expense of February is equal to 21,620, and we also have a loss of February right here. Okay, and on the other side, we need to find out the revenue of the February right here. So we have revenue right here. Okay, so how we got this number? Okay, so this number is the revenue minus the expense. So we're using $37,550 minus the expense, 21,620. So we got this number. So this is the gross revenue when you did not include any gain and loss. And how we calculate this number, this $400, okay, we're using the total gain minus loss. Okay, so in this case, the gains for February is equal to 1,200. Okay, and the loss for the February is equal to 1,600. So that's why the total loss, okay, actually the total loss for the February is equal to $400. But however, the total revenue increased a lot. Okay, it increased a lot during February. So you have your total net income, it will be equal to this plus this thing. So we have these things right here. So once again, the majority equation we're using revenue plus any gain minus any loss and minus any expense. It will be equal to our net income or the net loss. Okay. Once again, can anyone tell me? So you are accounting people. Okay, you are business major people. Can anyone tell me why the January, net income compared to February net income? February net income is much higher. Can anyone tell me? Is there anything pop in your head? This is a bakery store. Once again, a bakery store. Why the bakery store in, yes, Mallory?
Is it because of like Valentine's Day?
Oh, very good answer. That's correct. Yeah, it's because of the Valentine's Day. Okay, because of the Valentine's Day, okay, during February, their revenue goes up. Okay, so because their sales goes up, and that probably going to explain, okay, during the Valentine's Day, sometimes they producing more product. So during the February 14th, they may have some gains because they can sell maybe the bakery at a higher price. But if they cannot sell all the inventory during their in their inventory, if they cannot sell all of the cake on that day, so for the rest of the month, they may sell the cake at a discount value, right? So they may have some loss. But however, the total revenue compared to January is increased a lot. Okay, so very good point. Thank you, Mallory. Okay, so and in order to calculate the net income or net loss for March, we're using pretty much the same thing. We need to find out what is the key thing. So we have the loss of March right here. We have the revenue of the March right here. We have the expense of the March right here. And we have the gains of the March right here. So once again, how are we going to calculate this negative number? We're using our revenue minus our expense. So what we have is 42,800 minus 45,100. So we got this negative number here. And how we calculate the gain here? So we're using the total gain. In this case, is 5,600 minus our 3,700. Okay. So make sure you know how to do that, and then how we calculate net income. We're using these two things plus each other, so we get our net incomes here. Okay. So once again, for your first homework, you will see the question like this. So make sure you know how to do these kind of questions. Okay, like these kind of questions. Okay, well, how you going to calculate your net income? How you going to calculate your net loss? Okay, make sure you know how to do that. The equation, as we mentioned, the equation is right here. Make sure you know this equation. Okay, it's not very hard. Okay? It's just very simple add and minus questions. Okay, quick question right here for the equation. So once again, So for each of the independent situation here, calculate the missing value. How are you going to calculate this missing value? So he already gave you the very beginning, the top, okay, the top how to say equation here, asking you to find out this. So it should be very easy. You just need to fill out the point. Okay, so let me show you the answers right here. Should be very easy. Okay, so once again, let me show you if I'm using a calculator to do these things. Okay, so how are we going to get this $200? It's actually very easy. We're using 1250 minus the expense 1100 plus any gain 125 and minus 75. So what we got is this $200 right here. Okay. And how we get the revenue right at this case. So this is a little bit tricky because it asks you to calculate the revenue. So okay. So how we get this number right here. So we already have the expense, we have the gain, and we have a loss, and we have the net income right in this case. So we have an expense because we need to minus our expense. So we have negative 100,755. And then we have another, okay, loss here is equal to 1550. So what we have, the total expense or loss in this case is equal to 102,305 dollars, and we have our total net loss is equal to 485. So we need to plus 485. So what we got is right here, the answer. Okay, I don't know how this is. Okay, so yeah, you see this answer right here. Okay, do you know how to do that? This should be very easy. You just need to make sure that each side, okay, the left side, the number of the left side, it will be equal to the number of your right side. So you can do that questions. Okay, so you can easily to fill out these points right here. Very easy using pretty much the same way. Okay. So once you know that, we're gonna jump to talk to another financial statements. Okay, statement of the shareholder equity. The statement of the shareholder equity is the second financial statement created by the accountants. So remember the sequence, okay, how we're going to prepare each of the financial statements. The first one is income statement, the second one is the statement of the financial statement of the owner equity, okay? And it tells you how the value of the organization have right now, okay? Once again, for the statement of owner equity, it's like the statement of the cash flow. It gives you the beginning inventory or the beginning balance. You need to plus the net income, and you give you the net, okay, the ending balance. Okay, so in this case, once again, we assume the beginning inventory or the beginning statement is equal to 0, and the statement of the owner equity should be very easy. Just remember how we're going to get the ending balance. We're using the beginning balance plus any net income and minus any dividends, and it will be equal to our ending. Okay, in this case, okay, if the statement did not show anything about dividends, which means the company did not issue any dividends. But however, if you see on the statement say that the company issues some dividend, then we need to use the net income minus the dividends in order to get the statement of the owner equity. However, we're going to talk about more detail about these things in the future chapters. So in here, it just give you a basic idea, a basic introductions. Okay, so can anyone tells me why the income is in equity, is not in the asset, is not belong to the cash in asset? Can anyone tells me why we put the income in the equity, okay, not in the asset? If you still recall, asset is equal to liability plus equity. Asset is what the company already own, okay, and equity is what the company owners own. Okay, the company, the stockholder, okay, own to the stockholder, those kind of thing. So can anyone tells me why, in your opinion, why the income is not including in asset? Okay, it's not included in the cash items in the asset. Can anyone tells me? We actually talked a little bit about these things before. Anyone? Just try. You know, it's okay. If you answer correct, I give you a very big credit. We actually yes, Asha.
Yeah, is it because the income is of the employees and not of the company, so it doesn't count as the asset?
Not really. The income in this case, the income is already count as the income for the total company. So because this is a company, so the income is already count as the net profit for the company. So just once again, just need to think about why. Once again, why is? Let me give you a hint. Is talk about the time. The time. Anyone? No? Okay. So once again, the income, for example, for the companies, okay, let me give you another hint. So for the company, so if you, I don't know whether you guys go to the store, the department store, do you own a Macy car or Kohl's car? Whenever you're using your Macy car to buy something, when did you pay for your Macy car? Pay the balance for your Macy car. It may take a while, right? So once again, why the income is in equity but not in asset, in hard cash? Why the net income is not exactly equal to hard cash? Yes, Anja.
Does it have to do with the like actuarial accounting versus like cash accounting, where like
yeah
you count as income depending on when you log it versus when you actually get access to it?
Good job, Anja. Very good job. Thank you very much. That's a very good point. That's the answer I look for. So once again, the net income, some company, they may have some credit sales on the account. So the company, they may, okay, they already count the net income when they sell the item, but it may take a while for the company to actually get the actual payment from the customer. So, you know, during these times, what we call the accrual accounting or the cash balance accounting. So according to the accrual accounting, so in the United States, normally we using the accrual accounting is we calculate the net income or the net profit once we make the process, once we make the transaction. So if you're using your credit card, using your Macy credit card to buy a very fancy shoes at Macy, okay, Macy will directly calculate the net income, the transaction, when you make the purchase. But however, it may take you a while, it may take the customer a while to pay for the credit card balance, which means the company did not actually get the cash yet, but however, they already calculate for the transaction. So that's one of the majority reason why the income is not including in the equity. The one of the majority why the income is not included in cash. Okay. Another reason is, as we mentioned before, once the company have net income, the board of the director, they may decide whether they're going to issue dividends. Okay. Sometimes, okay, normally they will issue dividend at the end of the month or at the end of the year. Okay, so you are not sure whether the board is going to issue dividend yet. So you need to wait until the very end of the accounting cycles to find out these things. But thank you, Anja. I do hope you guys can understand, have a basic idea of the credit sales right now, because we're going to talk about these things in the following slides. Okay. So the owner equity, we're going to talk about the positive change in the owner equity. You can be, okay, like increasing by the investment of the owner. How we're going to increase our owner equity so the company can issue more stock then the total stockholder, okay, the total share, the value of the share we're going to increase. And on the other side, okay, the total equity will be decreasing by the distribution to the owners. What does that mean? If the company issue dividends, which means the company need to pay for the stockholder, okay, then the total equity will be decreased, okay. So the distribution for the owners to the owners, normally we are talking about dividends. Okay. So the distribution for owner represents some value of the organization. So the company need to pay for that. So it's an expense. So it will lower the equity. Okay. So once you know this, we're going to talk about our last item here, the balance sheet. Okay. So once again, we already talked about the majority of the very simple one of the balance sheet. We have the asset equal to our liability plus the equity. Okay, so what does the asset mean? The asset means, okay, what does the resource used to generate revenue? Okay, what does the company already own? The liabilities, what does the company own to the lender, the creditor? The equity is what does the company own to the other thing for the shareholder, the owners things. One of the good example we can make these things a little bit, maybe a little bit clear is, for example, you are buying a house. You're buying a house in the future. The house will cost you $400,000. Okay, the total house costs you $400,000. You only have the down payment. Okay, you only have enough payment, the down payment. You only have the down payment for $100, which means you need to pay for your mortgage. You need to borrow from the bank, the loan. You need to borrow is $300. Okay, so this is exactly what, pretty much like the way we prepare for the balance sheet. So can anyone tell me, if we're using the information here to prepare a balance sheet, what should be the asset? The asset is equal to how much? Can anyone tell me? Yes, Anja?
The asset would be the $400,000 of the house.
That's correct. Okay, so the asset is the total amount of the, or total value, okay? The total value of the house. So the asset is equal to $400, and the liability, okay, the liabilities is what you own, okay, what you owe, okay? So the liability in this case, okay, should be very easy. It should be equal to the money you brought from the bank, okay, because you still owe this money, okay? So the liability is equal to $300,000. And the equity, okay, is what does the owner of the company, okay? So you are the owner of the company, so you own this down payment of $100,000. So you already own this $100,000. So you will see the asset, it will be equal to $3,000 plus $100. Okay, so once again, this is the very important thing you need to know. The basic equation, the asset is equal to liability plus equity. Okay, very, very easy. Okay, make sure you understand this kind of thing. Okay, the balance sheet, we're gonna spend a lot of time to talk about each of the detailed item of the balance sheet or of the future in our future chapters. Okay. So we already talked about this. In order to prepare these things, we need to prepare the income statement first, and then the statement of the equity, and then the balance sheet. And last, we're going to introduce a little bit about our cash flow statements. So this is the key thing we need to talk about. Thanks for Anja. We already mentioned about a little bit about the cash-based accounting and accrual-based accounting. There's two very important things right now. The statement of the cash flow, if we're using we have two types of statement of cash flow, the direct way or the indirect way, which you're going to learn on your cost accounting, okay? Probably in the next 2 years, you're going to learn that. But in this class, we are not going to spend some time on that. But you do need to know what is the cash-based accounting and what is the accrual-based accounting. The majority difference between the cash-based accounting and the accrual-based accounting is the cash-based accounting will only record the transaction when you actually get the money. Okay? The cash-based accounting you only record your transaction, put it into your financial statement only when you actually get the money, okay? The accrual-based accounting on the other side is you record your transaction, you put your transaction into your financial statement when when the transaction of the business is done. Okay, is for example, back to our Macy example. If you go to buy a very fancy shoes that cost you $100 at Macy, okay, today using your Macy credit card, as accrued basic accounting, it will directly record on the sales day. Okay, so the accrual accounting, they record whenever the sales is made. But however, the cash accounting, okay, for example, okay, once again, for example, what day is today? Today's September, okay, 9/9, okay, 2020. Okay, so for example, you go to Macy and you buy $100,000 shoes, $100 shoes over there. Okay, so as accrued basic accounting, they will directly report on the sales day, which is today's day, 9/9. Okay, and then you decide to pay your credit card at the end of this month, which is okay 9/30. Okay, 9/30. Okay, you decide to pay your credit card on that time, which means the company will only get cash at that time. So according to the cash-based accounting, they only record once they actually receive the money. Okay, record the cash received date. Okay, so it should be recorded at 9/30 when you actually pay your credit card. So this is a huge difference between the cash-based accounting and the accrual-based accounting. The accrual-based accounting record on the transaction day, on the sales. Whenever you go to buy something, it will record on the day you buy something or you sell something. The cash-based accounting on the other time, it record when you actually receive the money. Okay, very, very important. Okay. So for example, the transaction by the cash base or the accrual base of the accounting. Okay. For example, if you're using $200 hard cash to buy stuff, then on the both of the cash-based accounting and the accrual-based accounting, it will be the same day. Okay, because you are actually using the hard cash to buy stuff. You're using $200 cash to buy stuff at Macy today. So the both cash-based accounting and the accrual-based accounting, it will be exactly the same day. Okay. However, if you're using a credit card to buy stuff, you're using $200 sales on an account, which means this is credit sales. You did not using cash to buy this. You're using a credit to buy this. So under the cash-based accounting, it will not recording on the financial statement. It will only record in the financial statement when you pay your credit. Okay, so when the actual cash is received. But however, on the accrual-based accounting, it will be recorded. Okay. And on the other side, okay, if you're using $160 to buy stuff, once again, if you're using hard cash, whenever you're using cash to buy stuff, there's no difference between cash-based accounting or accrual-based accounting. It will only have a difference when you're using credit things to buy stuff. Okay, so make sure you understand these kind of things. Okay, so once you know that, let me ask you some questions right here. Okay. So this company have the following transaction during the month of December. Okay, what would be the firm's cash balance? Okay, and in this case, we assume we are using the cash base. Okay, so if we're using the cash base, we're only gonna record these things on our cash flow balance statements when the cash is actually made. So let's go by each of these items to find out whether we actually use cash or either we actually receive cash. So the first one, the cash sales. So this is talk about the total cash you generate from your revenue. So this should be including, right? So this is correct. Okay, and payments for inventory. So this is the money you pay for your inventory. So this should be including also. And investment by the owners. Okay, so this is your owner gave you the money. So the investment by the owners, once again, you need to think about whether you receive this money. Okay, so the investment by the owners, so you should be already receiving this money. Okay, and on the other side, the supply use. Supply use. Anyone, do you think this should be including or not? I see somebody knock their head and see somebody shake their head. But okay, so once again, you need to think about the supplies. Whenever you have a company, the supply you use. Do you buy a supply? Do you, for example, if you are a company, imagine if you own a coffee shop, do you buy the coffee shop by days? For example, you assume you can sell 10 cup of coffee today, so you only buy 10 cup of coffee beans? No, you're not going to do that, right? You're going to buy a whole bunch of things and then using by the sales. So the supply use, the money you pay for the supplies, it may be happen in the future, or it may be happen before, or it may be happen in the future. So let's put a question mark right here, okay? And the cash withdrawn, this is the money you withdraw from your bank. So this is actual cash, okay? So this should be including. And the inventory received, once again, we're going to put a question mark here too. And the wage pay, this is actually the money you pay for your employees, so you should be including. Okay, and the cash balance at the very beginning of the month. So this is the total cash you already own at the very beginning of the month. So this should be including. So we have two question mark here. We have the supply use, and we have the inventory received. Okay, so once again, let's talk about, let me show you the answers and you will know. Okay, so you see, we use our beginning inventory, okay, the cash at the very beginning, $4,250 plus the cash sales minus your payments, okay, and plus the money you got from your investment, okay, and then minus the cash you withdraw, okay, and then minus the cash you're going to pay for your employees. So once again, you see, we did not including our supply use and inventory received in the cash balance. Once again, you need to know why we did not do that. Okay, the supply. Once again, the supply you use. Okay, you for the company, especially for the company, the supply they use. They may purchase a whole month or maybe a whole year's supplies at one time. So you cannot, okay, based on accrue or cash balance. You only, for example, if you buy 100,000 supply at the very beginning of this year, okay, and you did not pay for it yet. So under the cash balance, we cannot put these things onto your transaction, onto your financial statement. And on the other side, the inventory you receive, okay, you receive your inventory. Once again, you need to think about did you pay for these things or not? So once again, this is not, you are not sure yet. This is maybe happen on some credit sales. Okay, so the inventory received and supply use, okay, this is not based on the cash-based accounting. Okay, so I hope you do understand these things. And then we need to talk about a little bit about current asset, non-current asset, current liability, and long-current liability. Okay. These things should be very easy. We actually going to talk a lot more about these two things in our next chapter when we talk about the inventory, when we talk about asset. Okay, the asset, it will be including our current asset plus our long-term asset or long-current asset. Okay, the long-term asset. The current asset, okay, which means these things you're going to sell it or you're going to consume it within 1 year or less. Okay, and the long-current asset, which means these things you're going to use it or consume it or sell it for longer than 1 year. The current liability is pretty much the same thing like a current asset and a long current liability. Is the current liability, which means you need to pay for this amount less than 1 year or within 1 year. And the long current liability is expect to be you pay these things longer than 1 year. Okay, so the current liability is what we call sometimes what we call short time liability. Short time liability, which means you need to pay for this bank loan within 1 year. Long-term liabilities in the other side is what we call long-term liability. Okay, you may have 5 years or 10 years for you to pay for these things. Okay, so let's give you some example of current asset and long-term asset. So the current asset you have right now is the cash. The cash is very current. Okay, you may using this cash immediately. Account the receivable and inventory. The long-term asset we have the building, land, and equity. Especially for the building. The building you may use this building for very long time until it broken down. Okay, so we need to talk about for the long-term asset we need to talk about depreciation in the very future. Okay. And the note receivable, the note receivable is the money you borrow to the company, okay? And the time is very, very long. For example, maybe 5 to 10 years. And the patents is what we call the long-tangible assets. The long-tangible asset, the patent normally is like 10 years or 15 years, depending on the registered date. The current liability is the things you need to pay within 1 year, like the account payable and note payable. Okay, and non-current liability is note payable. So note payable, we have the long-term note payable and short-term note payable. Okay, so for example, for the treasury bill or the government bill is you buy the note payable for the government. Okay, it may take for like 10 years. Normally, it's the 10-year date you get your payment back. So you do need to understand the majority difference between the current asset and the non-current asset is the current asset is the thing you're going to use within 1 year. The long-current asset is the things you can use for a very longer time. On the liability part, the current liability is the things you need to pay within 1 year. The long-current liability is the things you need to pay, okay, maybe in the next 10 years. Okay, very easy to understand. So once you know that, so the reason we need to think about the time here, so the current and the long current, this is what we talk about time. Why the time is so important, especially for some company, their inventory, okay, so their inventory, the time they need to sell for their inventory is actually very crucial. Okay, very crucial. Because some industry, they may take a while for them to sell their inventory. And for some companies, they may take only maybe a day or maybe sometimes even hours to sell their inventories. So this is actually very important about the timing. So for example, okay, the stakeholder, they need to using the financial information to make decisions. Okay, so you need to think about when the company is going to generate money from selling the inventory. And when the company need to pay for the expense, when they need to pay for their liability. So the information, the financial information, we're going to talk about times. The times is very, very important. Okay, so you need to think about how can a company going to generate their money from the inventory. How quickly they can generate money from the inventory. So for example, compared to Walmart to a car dealer, the car dealer may take months to clear their inventory, right? Because in order to sell cars, it may take a longer time for you to sell your grocery, right? Can you understand that? So different industry, they have a different time to clear their inventory. And this is actually very crucial. So that's why we need to think about the time. And let me ask you questions, okay? Once again, this is related to maybe your normal life things. Which industry do you think have the longest time to sell their inventory? Which industry? In your opinion, which industry have the longest time to sell their inventory? Anyone? Lina, yes.
Like a clothing industry?
Clothing?
Yeah.
Close? Really? Anyway, good try. Okay, Marguerite, Marguerite.
Construction?
Instruction? What was that?
Construction?
Construction? No,
Like
actually.
hardware stores and things?
No, it's not that long. Okay. Yes, Jason. Jason.
Technology maybe, like Apple.
No, actually, Apple is actually sell their inventory so fast. Just imagine, okay, so actually talk about Apple. Apple going to have their new product announced next week on the September 15th. You're going to see their new iPhone going to sell immediately. So yeah, but anyway, anyone else? Yes, Anja?
I'm not sure if this is right, but I sort of feel like a car company.
It's close. Yeah, car company is close, but car company is not actually. If you talk about used car company, maybe it may take a while for the company to sell the used car. But if you talk about new car manufacturer, they actually sell their things very quickly. Normally within 1 year. Amber, I see you raise your hand. Yeah, you want to say something?
Maybe houses, like, construction, like houses. No?
Houses, if we talk about industry right now, the houses is actually in a very hot market because the mortgage is so low, so the houses actually can sell very quickly. So we're talking about industry. Just think about some inventory, some things, okay? Let me give you a hint. Maybe you guys you guys are too young to drink, but however, so I know. So if you think about that, okay, the correct answer, actually, if you don't believe, you can Google it. You will see the longest industry for the longest time for the inventory to sell for the industry is for the wine. The wine company. Oh, do you understand, right? The wine company. It takes a long time for them to sell their inventory because they have to store their wine for a very long time in order to make profit. Okay, so this is the wine company industry. Okay, and talk about this, okay? The next one is even harder for you to guess. So can anyone you guess which industry sell their inventory so fast? The quickest industry to sell their inventory. Yeah, Marguerite?
Apple?
No, yeah. Anyway, go ahead. Yeah, Anja, you can talk. Yeah.
I'd just go with like produce, like fruits and vegetables.
Sometimes, okay, it's not the quickest. This is hard, so if you guess this correct, okay, you can Google it, but I mean, Jess, yeah, I see you raise your hand, Jess. I can't hear you.
Bakeries, because they have to sell like that day.
Bakery is close. Bakery is pretty much like grocery store, so it's already very quick. But very good point. I can say like Anja and Jess, you are very close. But as I say, these things are very hard to. It's very hard to guess. If you cannot guess it, it's okay. But based on your answers, it already makes sense. So let me tell you directly the answers, okay? It's actually, but if you want to keep guessing, just keep guessing. Anyone else want to try maybe? Yes, Jason, I see you raise your hand. Yeah, go ahead.
Maybe like the fish industry because it goes bad really fast, maybe?
The fish, not actually. Talk about that. I just bought some lobster from Maine. Okay, it's actually very cheap right now. The lobster from Maine, they directly actually ship to you, via plane. So I ordered that like last Friday, I already almost finished of them during the weekend. Yeah, Mallory?
Is it the fast food industry?
Not true actually. Talk about fast food, For example, if you check if you check KFC and McDonald's, the material, the meat they actually buy is already stored for a very long time. So it's actually not very healthy. But anyway, it's close. But I mean, once again, this is hard. Believe me, if I say the answer, it will shock you. It's just at the same time when I know the answers, it actually shocked me. So let me directly tell you the answers. Okay, you probably won't guess these things. So the industry who sell their inventory the most quickest company in the whole world is Boeing. Boeing, the one who sell aircraft. Do you know why? Do you know why?
They break.
Yes.
Because
Anyone?
they break so fast.
What? No.
I'm joking.
Yeah, Margaret.
Because they have to actually, because it takes so long to like make the planes and such, and to come up with like new designs and get everything passed so that it meets all the safety standards for the multiple different countries, that when everything actually passes, it just sells.
It's close. Once again, it's close. Very, very close. Very good point, though. Yeah, it's a very new point I need to think about. Yeah, it's actually very close. Rahma, you want to add something?
Yeah, maybe they sell fast because they do like pre-ordering. Like the country would order, like the company, I want such and such plane, and they just prepare them.
That's good. That's good. That's the answer. Okay. So once again, just imagine. Okay, there's only 2 companies sell aircrafts. So just imagine if the company, other countries, they want to buy planes from Boeing. Okay, the Boeing, they don't actually have a lot of, they have, if you see, they only produce like 100 or 200 aircraft each quarter. And they already sell it like maybe years ago, or maybe 2 years or 5 years ago. So they have a lot of inventory, they did not produce yet, but they already sell it. So which means their inventory sell immediately or even maybe years ahead. Another thing is very close to Boeing is the very fancy car called Rolls-Royce. Rolls-Royce, Rolls-Royce. If you want to buy their car, you probably need to reserve one for 10 years, 10 years ahead. Okay, so which means their inventory already sell, 10 years ago. So that's what we talk about the inventory. So it's a little bit, I know this is a little bit hard, but I do hope you can understand why the time is very important for some, for the investor, for the stakeholders, okay? So that's for the current and non-current. We are not going to talk about anything about the equity or the legal structure here. So for the sole purpose, if you are a single owner, then the money you own for yourself is the money you own for the company. The difference between the single owner, the partnership, and the corporation is the corporation is owned by the stockholders. So whoever owns the stocks, okay, is the owner of the companies, okay? And this is the basic balance sheet equation. We already spent a lot of time here, so we are not going to spend more time here. This is a very, very early figure I would like you to know, okay? The things right here, okay, you see a T thing here. This is what we call the T transactions. We're going to spend a majority time to tell you how to use the T transaction. Once again, the T transaction on the left side is always debit, on the right side is always credit. Okay, and you need to know, because we're going to spend a majority time to talk about how to debit and credit each of these items, the assets, liability, and owner equity for the future chapters. So we're going to spend a lot of time how to record this transaction using this T account, okay? But once again, this is just a basic things tells you what we're going to learn. You don't need to worry about these things right now in this chapter. So you're gonna see these things in the future chapters, okay? So that will be all for this chapter. Actually, the rest of these things, we already talked about these things. So you don't need to worry about anything here. The majority thing I would like you to know for this chapter is you need to know, okay, there's 4 basic financial statements: the income statement, the statement of the retained earning, the balance sheet, and the statement of the cash flow. You do need to know how these things, okay, how these things is prepared in which order, okay, the income statement, retained earning, and then balance sheet, and then the statement of cash flow. The majority thing I would like to text you, and you're gonna see on your exam and on your homework, is majority is on your homework, is all about the income statement. Okay, the question you're gonna see is like this. Okay, you're gonna see your homework like this very soon, and the homework like this. Okay, so you only have 2 problems, very easy one. Okay, make sure you spend some time on Moodle. Okay, and the other thing is just very basic introduction of your other things. The balance sheet, you do need to know the basic equation of the income equal credit. These things. We're gonna spend more time to talk about the detail of these things. So once again, for this whole chapter, it just gave you the basic idea. What does this full financial statement look like? If you don't, okay, I don't require to remember each of the items, okay, for the retained earning balance sheet or the cash flow, because we're gonna spend this time to talk about these things in the future. But I do require, I do hope you can understand what's the basic about the income statement right here, okay? If I give you the information, how you're gonna write a very basic income statement, because this is the first step, okay, for you to do anything. So we're starting at the very beginning, okay? So that will be all for this chapter. I already post chapter 2, but chapter 3. I already post chapter 3 on syllabus. Make sure you spend some time to do that. On our Friday's class, we're gonna cover a little bit about chapter 3, and we're also gonna to do some in-class questions about chapter 2. Once again, it's more about income statement to help you to understand how to do the questions. Okay, so on chapter 3, we're gonna spend our majority time to talk about how we're gonna using the T account. Okay, how we're gonna using the T account to do these things. Okay, so please make sure you spend some time to read these read these chapters. We're gonna talk about these things majority for the next week. Okay, so that will be all for today's class. Do you have any questions for today's class? Yes, Mallory.
The PowerPoint you have posted is a little different than the PowerPoint you showed.
I know because for some questions, for example, the PowerPoint I post online, the questions they do not have the answers, and the one I use have answers. So that's the majority things. Because I want to ask you something, I don't want you just read the answers on PowerPoint. So yeah, so that may be the difference. Okay. Yes.
It didn't have that like bubble thing that you keep showing us.
Okay. Then I will change that once I finish the chapter. Okay. Do you have any more questions? If not, then I'm gonna see you this Friday. Remember to do your homework. I'm gonna post that this afternoon. Okay. Okay. Bye. Have a good day.